Hello, everybody. 10 days ago, California just passed a major change to the pass-through entity tax rules. This change will now allow a lot more companies to take advantage of potential tax savings. So in this presentation, we will get into how this new California tax law may help you. So let's go back to 2018 about how this all came about. So if you recall, with the 2018 tax change, they came out with a limitation on state, property, and local tax deductions, and they limited it to $10,000 on the individual tax return. This was also known as the SALT limitation. So as an example, let's say, for example, you had $8,000 of property taxes, and then you also had $10,000 of state and local taxes. So the total between these two was $18,000. However, the tax change limited this deduction to $10,000. So because of this, California has always been trying to find a way to get around this limitation so that people in high tax states like us here in California are still able to deduct their state taxes. So what did they come up with? They came up with a bill called AB 150. Also known as the pass-through entity tax. Prior to February 9th, this was not good for bigger companies with over $1 million in sales. But since February 9th, they just made this 9 days ago, the law changed to make this attractive for most every pass-through entity that has net profit. So even those with over $1 million of sales, this now makes sense. Whereas before this, it didn't make sense. So how is this going to work? Basically, first you have to have what's called a pass-through entity. A pass-through entity is something like an S corporation, a multi-member LLC, or a partnership. If you have one of these entities, then the pass-through entity tax might work for you. So let's say you have some profit from your company. The way it works is we would take that profit, multiply it by 9.3%, and then you're going to pay a tax on that. It's called the pass-through entity tax. So you're going to pay the 9.3% tax to the state government, which then becomes a federal tax deduction for you. Now what happens is that amount of tax that you pay in shows up as a credit on your California tax. So basically it shows up as a California tax credit on your individual return. Then what ends up happening is you get the deduction for the state tax, and it also shows up as a payment or a credit on your individual return. I know this is confusing, so let's put some numbers to it. So there's two parts to understanding how the pass-through credit works. Part one is you get a California credit for the payment that you make. So let's say, for example, that in your pass-through entity, you have $100,000 of original taxable profit. We would then multiply it by 9.3%, which equates to $9,300 in pass-through entity tax. So in this example, you'd pay in $9,300 through your company, and then it would then show up as a credit on your individual return. When it shows up as a credit on your individual return, it's also just like a payment. So it's like you just made a tax payment for your individual state taxes. So you pay the money in through your company, and then it shows up as a credit on your personal tax return. So the second part of this is understanding how you're going to save money on your federal taxes. Let's use the same example. So let's say your entity has $100,000 of original taxable income. You pay in that $9,300 in the pass-through entity tax. So rather than paying tax on $100,000, we subtract out the $9,300 that you just paid. And so now your new revised taxable income is $90,700. So because you're what's called a pass-through entity, all of your income flows down to you individually. So again, rather than paying tax at the individual level on $100,000, we subtract out the $9,300 in pass-through entity tax, and now you're only going to be taxed on $90,700. What that means is that your income was reduced by $9,300. Let's say your federal tax rate is 22%. So then your federal tax savings ends up being $2,046 in this example. So the end result is you are now able to deduct state tax through your pass-through entity. So how can you do this? Well, we could still do it for the 2021 tax year. In order to do so, you'd have to pay in your pass-through entity tax by March 15th to avoid any penalty. Because we're right around the corner, we may have to estimate the amount, and you may also want to overestimate to try and make sure we cover whatever is going to be owed for this pass-through entity tax. The California credit will still apply on the individual side for the 2021 year, so we'll see the credit on your individual tax return. But on your corporation or other pass-through entity, we're not going to see the tax deduction until next year, 2022. And the reason is you're paying the tax now, which is in 2022. So we're not going to see the tax deduction until next year, but we will see the California credit pop up on your 2021 tax return. For 2022, the California credit will apply towards the 2022 tax year. The deduction for the tax paid will also happen in 2022 for any taxes paid in that year. If you wanted to do it for 2022, you must make a payment of $1,000 or 50% of the 2021 credit, whichever is higher. The amount is due no later than June 15th. That payment date is firm, and if you don't make it by that date, you cannot elect into the credit for 2022. A second payment for the remainder of the credit should be paid by December 31st of 2022, but no later than March 15, 2023. However, we would still want to pay it by December 31st so that we could get the full 2022 tax deduction for that tax paid. So there's some important things to consider before moving forward with the pass-through entity tax credit. First of all, your company has to have profit in order to take advantage of the credit. Without profit, there's no credit. Second, your company has to have sufficient profit so that we get a decent tax savings. In the example we gave you earlier with $100,000 of profit, the ultimate tax savings was a couple thousand. In that case, it's clearly worth it. So for me, the cutoff is probably about $40,000 in profit to make it worth the tax savings and all the effort it's going to take to get the money in to take advantage of the credit. Lastly, we've got to act now. This change just came about 10 days ago. So if we want to take advantage of this for the 2021 tax year, we have to act now so that we could estimate the amount that you'll need to pay in by March 15th, which is right around the corner. So we've got to move very quickly. This is an extremely difficult tax credit to understand. I hope that this presentation helped to give you a basic understanding of how the pass-through entity tax works. If you wanted to move forward with this for the 2021 tax year, please let us know immediately, and we'll make every effort to help you as soon as we can. If you didn't want to start this until the 2022 tax year, then we would still have some time because the first payment is not due until June 15th. This major change happened just 9 days ago, and we're trying to react as quickly as possible. It'll be extremely challenging, but we're up for the challenge. And we'll try to make this happen for as many of you as we can. As always, feel free to email or call us with any questions. And as you know, we're here to help you. Thank you so much.